Okay, Tyler, we're going to talk about another one that you and I both own and have owned for a long time. In my case, I've owned for a long time. And over the long term, it had been a big winner. That's not the case lately. That's Brookfield Infrastructure. Stock is down like 40% from the all-time high. Tyler, we need to talk through what's going on with this business because the stock is down. A lot of it, the basis of owning it is dividend yield. Yield's gone up, of course, as the prices come down. Uses debt to raise a lot of capital. Historically, has invested in assets in a certain way. Looks like that's starting to change. Tyler, are the changes that it's making, are they going to be good for investors, or is this a business that's deviating from its past success?
I'm always ready to talk about the things that nobody else wants to talk about for some reason.
But people should be talking about, if not talking about, certainly thinking about with their investments. I'm Jason Hall. This is The Smattering. Our video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/The Smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check out that link after this video. Okay, Tyler, what is the thesis for Brookfield Infrastructure? Maybe what was it? And then we'll talk through what's begun to change.
I guess you could say the thesis, I think that and I think you, I'm assuming, or we're in the same camp of why we bought it originally, was this was a business that acquired a lot of infrastructure-based assets that were going to basically spew out cash very, very long periods of time.
Toll roads, ports, natural gas infrastructure like utilities,
electrical
and
transmission lines, things like
water,
that. Yep.
Waste,
all the things that just make the world go around and we don't pay much attention to.
Telecommunications. Yeah, exactly. All the stuff that we never think about until it's gone, right? Until it's not working. So that's the business.
And historically, Brookfield have been pretty good at, well, timing's not the right word, but basically allocating smartly, perhaps going into a lot of assets that people weren't that interested in at any given moment.
Getting really good multiples on their investments on assets that had potential to be more profitable and to grow cash flows at a faster rate than inflation.
An asset manager frequently looking for bargains.
This is the result, even with the dip, the big dip in the stock price here recently. It's more than doubled the S&P 500 since Brookfield Infrastructure went public on the New York Stock Exchange. So it's been a winning formula for a very, very long time until more recently. So again, that's the long-term thesis, those assets that generate cash. It's a good, smart buyer of those assets at good multiples, finding the ones that they could improve and leverage better cash flows out of. And then there's another part of it that's not just buying them well, but then taking them when they get to that critical mass of, okay, we can't really grow it at much more of a rate, but I bet we could probably find a buyer that's going to pay a better premium than when we bought it. And it's worth a lot more now. And then we see these other opportunities where we can redeploy that capital to do it again. Capital recycling, Tyler, that they've been really, really good at doing.
Yeah. And it's been basically the thesis of why this company has worked for so long. We can go over the very simple basic finance or institutional investing reason why the stock is down. It's like yields for less risky things are up. Therefore, to compensate for higher risk, you should have a higher yield. So a lot of institutional money is probably flowing out of this, going to safer yields, and therefore price is going down, yield is going up. And that's the basic financial thesis as to why a lot of the yields are going up today, because you should. It's called the equity risk premium for a reason. You should be rewarded for taking on greater amount of risk relative to what is available in the market right now. So that, I think, spells out some of the why it's gone down. But I think there's a couple other things that we should hash out here. And Jason, you and I have talked about this previously, is some of the things that they're investing in seems dramatically different than what we're so used to them acquiring. Like you said, electric transmission lines, pipelines, toll roads, things like that. Yes, they can be, we'll call them cyclical to the broader environment or economic environment.
Right.
Don't do
They're
great.
not recession proof, but they're far more recession resilient, maybe is the best
Right.
way to think about it. Right.
Good way of saying it. But in recent years, you've seen a change in capital allocation into other places, I would say are more cyclical outside of the typical economic cyclicality. I think a great example of that was its recent acquisition of Triton International. Triton is basically owns and leases out containers. You hear intermodal a lot. It's basically the big steel, 25-foot steel containers. And that is a business that is incredibly cyclical and can move very independent of the market. I think it was an industry we followed for a while and then really fell into disarray for quite a while. So you have that. You have its recent venture into a semiconductor fab. They're a joint venture partner with
This is the
Intel.
partner with Intel, right? The Ohio fab that they're building for their contract manufacturing business. Brookfield's going to own 49% of that factory. Semiconductors are an incredibly cyclical industry. So an interesting,
Yep.
again, say it with me, cyclical industry, secular
Secular
tailwind.
growth. They're starting to get into data centers, which
Mhm.
again operate on their own cyclical trends. I'm not saying this is bad, right? Like sometimes being diversified across different cycles can be good for the overall portfolio. The thing that I don't have the right answer for is whether or not management was able to do a great job of allocating capital into these new markets. The default answer for so long has been yes, because like we said at the beginning, they've been great at shopping in places that people don't want to shop and finding good deals on good return, assets that they're going to be able to tune up and flip if they have to, and recycle that capital into something that they can grow and flip and basically be that kind of portfolio manager of infrastructure assets that they've been for a very long time. My question is if they're going to just be really good at doing that. Again, I don't know if I'm right or wrong, but it's just a question that I have. It's the unanswered, unknowable for me that maybe doesn't make me look at Brookfield Infrastructure at its 5.9% yield today and say, yes, absolutely, have to buy it right now. There's just enough of a twinge of doubt to make me say, let's see how this goes for a little while.
And that is typical for you, Tyler. You're not going to lean over the edge of the cliff and take a peek. You're going to stand back and maybe somebody else can take a look and they'll tell you what they see or take a picture and show it to you so you've got evidence. I'm going to go out on the limb here and I don't feel like I'm going out on a limb. I do think Brookfield Infrastructure, I do think it's a buy at these levels because the reality is over time, they have evolved that process. They used to buy timberland at one point. They've bought all kinds of different things at different times in their business, and they have proven to be really good opportunistic value buyers. And I expect that that's going to continue. And here's the most important part of it, Tyler. There's two pieces to this. Number one, they've proven incredibly patient. They will say that when they get to that point of critical mass with an asset, they know they have somebody that will buy it and they will be able to get a good multiple, a good premium. They will sell that asset even if they are not ready to redeploy the proceeds that they receive. And they have to sit on those proceeds for a couple of quarters or more. They will be patient and they will strike when the opportunity presents itself. I think that they have proven that's deeply ingrained in their Brookfield culture. The second part of it is I think having their parent company, Brookfield Corporation, and Brookfield Asset Management, their partner company, means that they will consistently have access to capital to be able to move quickly. They don't have the pressures from Wall Street to report every quarter and to show growth every quarter. They play to the beat of their own drummer. And I think that is so valuable for this business. And because they've proven to be really disciplined value buyers, I think that now is a good time to buy. And I think for long-term investors, it's going to prove out. The capital environment is different. I think it is going to be harder for them to find buyers. I do think that is the biggest risk right now when they do have those assets that they're ready to sell, finding a buyer. Because those buyers that were buying those cash generative yielding assets, we're largely buying them because of the yield. Guess what? There's competition for yield right now. So they're going to be competing when they're selling assets against things like fixed income, bonds, mortgage-backed securities, other asset classes that weren't really as appealing as the assets that they may have been selling before. So I think that's the biggest caution for investors is don't necessarily expect the same rates of return that Brookfield has generated in the first 12 or 13 years of its existence as a public company. Those rates are probably going to come down a little bit because the cost of capital is higher and there's more competition and lower multiples when they're selling stuff. But I do think this is an appealing investment right now. And I think investors that buy at these prices are probably going to be quite happy if they hold it for 5, 10 plus years.